Every major financial collapse over the last 100 years has unfolded the same way. Not variations, not echoes, the exact same sequence. 1929 followed it, 1987 followed it, 2000 followed it, 2008 followed it. It's a five-stage process that begins months, sometimes years, before the crash becomes visible. Wall Street understands this pattern. The Federal Reserve understands it. The people who manage capital for billionaires understand it. Most people don't, because if they did, they would exit before the collapse, not after it. Today, I'm going to walk you through all five stages, and I'll show you exactly where we are right now in that sequence. Spoiler, we're much further along than most people realize. In 1929, a man named Roger Babson stood on a stage at a business conference and said 9 words that instantly turned Wall Street against him. Sooner or later, a crash is coming, and it may be terrific. The room laughed. Newspapers ridiculed him. Irving Fisher, the most famous economist of the time, publicly dismissed the warning, insisting stocks had reached a permanently high level. 47 days later, the market collapsed. Fisher lost everything and died broke. Babson made a fortune and later founded a college that still exists today. What most people don't realize is that Babson wasn't guessing. He had built a systematic framework for analyzing financial conditions: credit expansion, market concentration, institutional behavior, liquidity, and what he called trigger vulnerabilities. 5 factors, 5 stages. I spent 3 months digging through historical records, Federal Reserve data, and academic research to see if his framework actually held up across different crashes. It does, every single time. Let me show you. Stage 1 is the credit explosion, and this is where it always begins. Not with greed, not with speculation, with debt. Before every major crash, credit grows faster than the economy can sustain. People borrow money they can't realistically repay and use it to buy assets. Prices rise. Rising prices create the illusion of wealth. That illusion fuels even more borrowing. It feels like prosperity. In reality, it's a trap. In the late 1920s, margin debt surged. Ordinary Americans were putting down 10% and borrowing the rest to buy stocks. By 1929, margin debt matched the size of the entire federal budget. Factory workers were leveraged like hedge funds. In 2007, it was mortgage debt. Banks engineered products that allowed people to buy homes with no money down, then bundled those loans into securities and sold them to pension funds. The leverage was hidden, but it was everywhere. In 2000, it was corporate debt. Companies with no profits borrowed billions to expand, using inflated stock prices as collateral. When those prices fell, the structure collapsed. Now look at today. Official margin debt sits near $750 billion, but that figure captures only a fraction of the leverage in the system. Add securities-backed lending, options exposure, corporate debt above $10 trillion, and government debt exceeding $34 trillion. Measured against GDP, total debt in the U.S. economy is higher than it was in 1929, higher than 2008, and higher than at any point in recorded history. Stage 1 isn't just flashing red, it's burning. Stage 2 is the concentration trap. And this is something finance textbooks rarely explain. Crashes don't happen just because prices are high. They happen because risk becomes concentrated. When a small group of assets carries an outsized share of the market's value, the system becomes fragile. One crack is enough to pull everything down. In 1929, the market revolved around a handful of glamour stocks. Radio Corporation of America was the star. It surged from under $2 to over $500 in just a few years. Most investors didn't understand radio technology. They only knew the stock kept rising. When RCA broke, the market broke with it. In 2000, it was the dot-com era. Cisco, Intel, Microsoft, just a small cluster of names. The NASDAQ became a bet on fewer than a dozen companies. When they rolled over, trillions evaporated. In 2008, concentration was hidden inside the banking system. A handful of banks held the majority of derivatives exposure. When Lehman failed, the entire structure nearly collapsed. Today, the concentration is obvious and largely ignored. The top 7 stocks in the S&P 500 now account for over 30% of the index, at times closer to 35. That means when you buy an S&P 500 fund, the core of most retirement accounts, you're not buying 500 companies. You're making a massive bet on Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those stocks fall 50%, your diversified index drops 15 to 20%, even if everything else holds steady. And these companies aren't priced for good performance. They're priced for perfection. Any disappointment feeds selling. Passive investing amplifies the problem. Money flowing into index funds automatically pushes the largest stocks higher, increasing their weight and attracting even more inflows. It works smoothly on the way up. On the way down, it reverses. Outflows force selling of the biggest positions first. Selling creates more selling. This is stage 2, and we're deeper in it than ever before. Stage 3 is the smart money exit. This is the stage that exposes how the system really works. Before every major crash, institutional players, banks, hedge funds, family offices, billionaires quietly reduce risk. They sell positions, they raise cash, they buy protection. They don't announce it, they don't warn anyone. Publicly, they often say the opposite. Stay invested. Fundamentals are strong, don't panic. While they're saying that, they're already moving toward the exits. In 1929, the Morgans and Rockefellers began liquidating months before the crash. Bernard Baruch was almost entirely in cash by September. Joseph Kennedy sold after his famous shoeshine boy moment, but more importantly, because he had access to people inside the banking system. Regular Americans kept buying. They provided the exit liquidity. In 2007, hedge funds were shorting subprime mortgages a year before the collapse. Goldman Sachs bet against securities it was selling to clients. Mortgage executives sold their own stock while assuring investors everything was fine. Again, regular people kept buying. They were the exit. Today, insider selling is at levels not seen in decades. CEOs, CFOs, and board members, the people closest to the numbers, are selling aggressively. The ratio of insider selling to buying is extreme. At the same time, retail investors continue pouring money into the market through brokerage apps, retirement contributions, and passive funds. Smart money is selling. The public is buying. This isn't random. It's the pattern. Stage 3 is flashing red. Stage 4 is the liquidity illusion. This is the most deceptive phase because everything still looks normal. Prices hold steady or even rise. Trading appears healthy. On the surface, nothing seems wrong. But beneath that surface, the liquidity supporting the market is quietly disappearing. Liquidity is the oxygen of financial markets. When it's abundant, transactions flow smoothly. Prices adjust gradually. Shocks are absorbed. When liquidity vanishes, markets stop functioning. Prices don't drift, they gap. Small sell orders cause massive moves. Feedback loops take control. The collapse accelerates itself. In 1928 and 1929, the Federal Reserve raised rates to cool speculation. What it actually did was drain the liquidity holding asset prices up. For a while, nothing happened. Markets kept rising, convincing people the tightening didn't matter. Then selling began, and there were no buyers. Bids vanished. Prices didn't fall. They collapsed. The same pattern appeared in 2007 and 2008. Rates were rising. Credit was tightening. Stocks and housing stayed elevated. Everything looked fine until Bear Stearns failed, then Lehman. Suddenly, liquidity was gone, and markets fell by half within months. Now look at today. Interest rates have risen at the fastest pace in 40 years, jumping from 0 to over 5% in less than 2 years. The Fed has been pulling hundreds of billions of dollars out of the system through quantitative tightening. Yet markets sit near record highs. Many believe this proves tightening doesn't matter, that a soft landing has been achieved. It hasn't. The strain is already visible. In March 2023, three major banks failed in a single week: Silicon Valley Bank, Signature Bank, and First Republic. They collapsed under liquidity pressure from rising rates. Emergency lending programs were rushed in to stabilize the system. Those measures are temporary. They don't solve the problem, they delay it. Even the US Treasury market, the backbone of the global financial system, has shown moments where liquidity nearly vanished. The most liquid market on Earth is experiencing structural stress. This is stage 4, calm on the surface, oxygen draining underneath. That brings us to stage 5, the trigger. This is the one nobody can predict, and that's what makes it so dangerous. The trigger doesn't cause the crash. The crash is already baked in by stages 1 through 4. Excess debt, concentration, smart money exits, and disappearing liquidity. The trigger simply determines when it begins. In 1929, the spark was a minor British fraud case involving Clarence Hattrey. It seemed irrelevant to American markets, but British banks exposed to the scandal needed cash, so they sold U.S. assets. Selling led to more selling. Within weeks, the market was in freefall. The fraud didn't matter, the fragility did. In 2008, the trigger was Lehman Brothers, but it could have been Bear Stearns, AIG, or any number of institutions. The system was already primed. Lehman was just the match. So what will the trigger be this time? Nobody knows. That's the nature of triggers. It could be geopolitical, an escalation around Taiwan, the Middle East, or Russia. It could be financial, a major hedge fund failure, a sovereign debt crisis, or a derivatives accident. With over $600 trillion in notional derivatives, one counterparty failure could ripple through the entire system. It could emerge from banking, commercial real estate, or politics. Or it could come from a place no one is watching. That's usually how it happens. The trigger is never the thing everyone fears. It's the thing no one sees coming. What I do know is this: when stages 1 through 4 are all flashing red, the trigger usually follows within 12 to 24 months. All 4 stages have been in place since late 2024. That puts the window somewhere in 2025 or 2026. Let me be clear about what this does not mean. I'm not saying the market will crash tomorrow. Timing is impossible. Markets can stay irrational longer than most people can stay solvent. Anyone who claims to know the exact date is lying. I'm also not telling you to sell everything and hide. That isn't strategy. That's panic. What I am saying is that the same conditions that existed before every major crash of the last century are present right now. All 5 stages are active, or about to be. This isn't normal, and it isn't hypothetical. Roger Babson didn't just foresee the 1929 crash, he prepared for it. While others were fully leveraged, he held cash. While the crowd bought stocks at the peak, he bought land and hard assets. When the collapse came, he was positioned to survive and to win. Irving Fisher, the brilliant economist who mocked him, lost everything. His wealth, his reputation, his legacy. The difference wasn't intelligence. Fisher was likely smarter. The difference was attention. Babson respected the signals. He positioned for what was coming, not for what he hoped would happen. You face the same choice now. You can look at this data and decide it doesn't apply to you. Markets always recover, right? Maybe this time is different. Or you can ask harder questions. How much of your wealth is tied to the stock market? Your investments, your retirement, your pension, even your home equity? How much of that depends on a small group of mega cap stocks continuing to rise? If markets fell 50% over the next 18 months, as they did in 2008, would you be okay? Or would it set you back a decade? I'm not a financial advisor. I'm a historian. I study patterns, and the pattern is clear. The people destroyed by crashes aren't stupid. They're unprepared. They trust reassurances. They assume someone will warn them if things get dangerous. No one warned them in 1929. No one warned them in 2008. No one is going to warn them now. The warning is the pattern. And now you've seen it. What you do next is up to you. If this helped you see something you hadn't seen before, subscribe and turn on notifications. I'll be breaking down each stage in detail in the weeks ahead, including the specific data you can track yourself. Knowledge isn't power. Applied knowledge is power. The signals were there in 1929. The pattern was clear. People chose not to see it. Don't make the same choice.